when trying to get a feel as to how state taxes came around, we really have to look at the 1800s. Before the time of Federation, the 6 Australian colonies would raise revenue however they could. This, in the early days, would largely flow from the sale of land. There were taxes, duties, customs, excises, and tariffs that were imposed. Some of these were protectionist in nature, that were imposed between the states. But overwhelmingly, all of the systems of revenue the colonies had were there because they were easy to do. There was nothing really about those taxes to do with fairness or any form of equity between citizens. It was about administrative convenience. By the end of the 19th century, the colonies were more able to organize themselves. They had bureaucrats, they had systems in place, and as a result, the tax base started to shift. This move away from the sale of land, which by its nature is finite, towards having systems such as land tax, payroll tax, and income tax was really this defining characteristic of the end of the 19th century. Not all of the states had income tax or payroll tax by the end of the 1800s, but most of them did by the first few decades of the 20th century. Note that the taxes, the payroll taxes and land taxes, were actually levied by the Commonwealth as well. But during the 20th century, these were gradually returned to the states, and the Commonwealth sort of moved out of that domain. The one area of taxation that the Commonwealth did retain is the income tax. During the First World War, the federal government took it upon themselves to start levying income tax. Now, some of the states already were doing this, and after the war, the Commonwealth relinquished this, but again, during the Second World War, they again took hold of the income tax. And the way that set it up was that the Commonwealth was allowed to tax, and the various states went to the High Court during the war, and the High Court upheld the fact that they were allowed to tax income. The challenge really flowed after the war, when the Commonwealth refused to give it back. They pretty much said, look, we're still going to carry on doing income tax. You're more than welcome to do so yourselves, but it's going to be politically unsound to do so. And so that challenge between the Commonwealth taking the largest source of revenue and not giving it back really led to the states starting to have fiscal difficulties. And this was further exacerbated in the 90s in Hart, New South Wales, where the High Court had said that in situations where the states are levying some form of excise, but kind of disguising it as a service, in this case for tobacco, in those situations that's going to be unconstitutional as well. And so towards the end of the 90s, there was a great deal of difficulty in Australia in terms of this radical difference in the tax base between the federal and the states. At the end of the 90s, the tax base was reformed in Australia. And these days there's a much clearer delineation between the sources of tax revenue for the states and for the Commonwealth government. The key things to note is that the Commonwealth has the income tax. This is applied both to individuals as well as to companies. Part of the purpose of federation was to try and prevent the states from creating barriers between each other and elsewhere. And as such, the federal government has been tasked with the customs and excises powers. And so fuel, petroleum, alcohol and nicotine, they have exclusive power to tax those areas. The key reform in the late 1990s under the Howard government was the GST, Now, the purpose of GST as a sales tax was that it was promised that that would be collected by the federal government, but then granted to the states using a somewhat complex formula. Fringe benefit tax, which arrived in the 1980s, was also a system really designed as an anti-avoidance mechanism to prevent people from having non-cash benefits given to them in lieu of some form of salary or wage. Federal government also has what's called resource rent taxes. They also, in running the superannuation system, have taxes that relate to money going in and coming out of super. And they have the carbon system as well, the carbon pricing and emission trading systems as well. Leaving aside money that the federal government grants to the states as part of the GST redistribution, the state's tax base largely comes from land tax, stamp duty, which is also known as transfer duty, from payroll tax, from certain license fees for things like gambling, and from royalties from minerals. The states do generate a little bit of money from state-owned assets, but generally the bulk of their revenue comes from land tax, payroll tax, and stamp duty, as well as royalties. Now, in states, local governments run the day-to-day minutiae in terms of local government areas. Local government bodies such as shire, regional and city councils are incorporated under Queensland legislation, and these local bodies are given power by the state governments under that legislation to levy people who own land within those areas. And we call that form of taxation of local residents under local government regimes, we call those rates. Sometimes we call them council rates, but they're functionally a part of the local government's ability to generate revenue from local residents. When examining the tax administration system in the states, you'll find that the body that runs the various tax administration departments in each of the states and territories actually operate kind of similar to how the federal one does. So the Tax Administration Act 2001 in Queensland is quite comparable to how the equivalent run in the other jurisdictions. The key things to note is that the State Commissioner for Revenue, which is the head of what we call the Office of State Revenue, or OSR, that body is tasked with managing only a few statutory frameworks, because there aren't a great myriad of taxes in the state system. Each of the taxing statutes has systems in it for taxing and coming up with calculations and mechanisms for doing that and carving out exemptions. It also has systems for assessing and systems for collecting as part of that. Now, the system of collecting is generally unified across the various statutes that they tax in Queensland. And note that under the Tax Administration Act in Queensland, the systems for lodging objections and then seeking review of those objections very much mirror the federal system of seeking an objection, for example, from the Commissioner of Taxation, and then seeking review in the AET. I guess the structural difference there is that when seeking a review, that a particular taxpayer who's dissatisfied will go to QCAT instead of the AAT, and then would seek further review through the Queensland Supreme Court. We're going to look now at land tax. Now, land tax, which is different from rates, is a tax which is levied by the state commissioner, and it's levied to owners based on the unimproved value of taxable land as at the 30th of June. Now, that may sound simple, and that's because it actually is quite simple. It is almost surprisingly so. Basically, if you happen to own a packet of land in Queensland on the midnight of the 30th of June, you will become liable to pay a certain amount. And there's a percentage that of the value of the land. Now, there are quite a lot of exceptions in terms of land tax, so that there are mechanisms and systems whereby people either don't pay or particular types of land are exempt. But the starting point is on the 30th of June every year, the owner of land must pay tax. One of the reasons why land tax is endured is that, other than the various exceptions that apply, it's very, very simple. Land doesn't move, and it's easy to determine who the owner is. Essentially, the Commissioner of State Revenue would just have to look at the Titles Office as at the 30th of June to cross-check. It's trivially easy to see who owns land. Thus, the calculations for determining your land tax payable each year are pretty straightforward. You just look at what packets of land are owned by a particular taxpayer, and note that when determining land tax, you actually add together all of the packets of taxable land, work out what the aggregate is, and then it's that amount that you can be paying tax on. So once you've determined that, then you've got to work out which packets of land are going to be exempt or have some form of exemption. After that, we then calculate what the taxable value of the land which isn't exempt, and once you've got that number, you just work out what the applicable tax rate and the mechanisms for applying the tax rate are very, very simple. So when calculating land tax, we need to start by determining who the owner is. For law students, this should be pretty straightforward. It's the person with legal title. And that can be the person who is the single registered owner of land, or it could be persons who jointly own a packet of land. And note at this stage that all of those persons will be assessed to pay land tax. Later on in the calculation step, we'll look at apportioning these things out. The starting point is, if you are an owner, be it on your own or jointly, you on the 30th of June, you will have to pay land tax. Also important to note that the trustee of a packet of land where things are held in trust, is going to be the person who is taxed for that particular packet of land. Also, it's important to note that tenants are not liable for land tax. It's only the owner, the legal owner of a particular packet of land as at the 30th of June. In terms of co-ownership, it actually doesn't matter whether or not you're in a joint tenancy or tenancy in common. It really doesn't matter. Each person who is an owner is going to be deemed to be liable to pay land tax. It is also important to note that life tenants, if you have a life tenancy, that you're not considered to be the owner in that situation. Also, in situations where there are more than two dwellings in a particular packet of land, and therefore a body corporate is required, a separate entity with legal personality, which its objects are to manage and look after that particular collection of dwellings. In that situation, the body corporate is not going to be considered to be an owner either for the purposes of land tax. And where an entity holds a mortgage over a property, that while they are the mortgagee, they are not considered to be owners. If the mortgagee exercises a power sale and then it's on sold to a third party, then that third party is going to be deemed to be an owner at that point. Or if the mortgagee takes possession as part of this process, then in that situation the mortgagee will be considered to be an owner. But by default, unless those things have happened, mortgagees will not be considered to be owners for the purposes of land tax. Some interesting points come up where land is held in trust. This, for students of tax law, is actually a pretty important set of rules, because where a person is a trustee, that person in their capacity as a trustee is assessed to pay land tax. Now, usually in situations where a person is a trustee and there is a packet of land and there's a packet of money associated with it, the trustee will pay that amount of tax out of that packet of money or be reimbursed from that packet of money. But it's super important to note that having being a trustee over some land means that you are taxed wearing that hat. You aren't taxed as an individual. The calculations in terms of the land that you own as an individual is separate and distinct from you as a trustee. Now, it's also important to note that as a quirk of this system, where a trustee is a trustee across multiple trusts, they will be grouped together if and only if the two or more trusts have the exact same beneficiaries. So if the beneficiaries are different, even by one person, either one more or one fewer, then the trustee is deemed to be a different person in regards to that trust. In other words, they're going to be calculated separately. So as we'll see a little bit later, where there is a certain threshold for the paying of land tax, that if you were, for example, to own multiple packets of land and each of them falls under the threshold amount, if you put them in trusts, in say 4 or more separate trusts, all with different beneficiaries, each one of those trustees is going to be unique, and each one of them is going to be assessed on land tax themselves, and each one of those is going to have the threshold amount calculated for them. In other words, this certain amount of money that is not land tax is not payable on. So it's important to note, because it's something of a quirk of this legislation, in that it's quite a straightforward mechanism for I guess a person in the position who's able to set up multiple trusts to be able to bypass this particular area of taxation. Finally, just note that again, life tenancies are ignored for the purposes of calculating land tax. Like all areas of taxation, there are certain exemptions for certain classes of taxpayer, and in this case for certain types of land. And these fall in 3 broad categories. You've got land which is owned by particular persons. We've got land which is being used for particular purposes, and we've got the principal place of residence exemption. I'll go through each of these in turn. So we'll look first at the land tax exemption for persons, and perhaps this is a little misleading because it's not about individuals. Basically, the Commonwealth or the state of Queensland is always going to be exempt from land tax. And local government bodies and public authorities will usually be exempt. So by default, they are exempt. However, specific legislation can be passed which allows for those bodies to be taxed. Note, though, that if one of those bodies has a packet of land and it's being held for a particular purpose, and then that land gets transferred to a third party who isn't a local government body, a public authority, the state of Queensland or the Commonwealth, then the exemption will disappear, even if that purpose carries on for that particular packet of land. So the exemption in this situation only attaches to the classes of person, and really they're government entities. This second category of exemption, while technically it's an exemption for fulfilling a particular purpose, it also attaches to particular persons as well. So the first of these is charities. So a charitable institution, which is also undertaking a charitable purpose on a particular packet of land, is going to be exempt from land tax in regards to that land. It's a pretty narrow sort of exemption, really. It doesn't apply for just non-for-profits generally. However, there are some other types of land which, if it's used for certain purposes, is going to make the owner not be liable for land tax as well. So those include primary production businesses, pretty important one. So farms are not going to be taxed on land which is used for that purpose. So primary production businesses running such a business on land, that land is not going to be liable for land tax. Also aged care facilities, retirement villages, supported accommodation, those types of beneficial services for the elderly or the infirm, so to speak, are going to be also exempt from land tax. You've got public areas, public recreational areas, cemeteries, and caravan parks, they are exempt as well. Again, the owners of those areas will not have to pay land tax, provided that they're being used for that particular purpose. Trade unions, so where there is a trade union that owns land and is using it for trade union purposes, they will not have to pay it either. And what we call friendly societies, they are going to be exempt if being used for the specific purposes of objects of their organisation. The third category exemption is, again, a pretty important one, and that is the land that a person owns and lives in is exempt. It actually doesn't matter how expensive the particular residence is. If you're an individual and you use a packet of land as your home, it's going to be exempt from land tax. Now, it's also exempt if it's owned by a trustee, but only in the situation where all of the beneficiaries use it as a home. So it might just be important to note that Section 41 of the Land Tax Act, because if at least one beneficiary does not use it as a home, then that section won't apply. A couple of other things to note, that the occupation of the land doesn't have to be exclusive as part of that to get an exemption. So if you're, for whatever reason, you can't use all of a particular residence, that's going to be fine. However, if you do use a residence partially for some form of business, then that fraction of what would be the residence which is used for the business is going to be liable. It's going to be apportioned accordingly. So once we've determined for a particular taxpayer which pieces of land they own as at the 30th of June, we then have to add them up. So you just add up the total taxable value of all of the packets of land. And note that this value is the unimproved value of land. It's only the land itself. It's not buildings or other form of fixtures that have been attached to the land. It is only the land itself. Now, for an individual, and also for trustees in bankruptcy and for incapacitated persons, once you've taken all of the taxable value of all of that land, added together, if it is more than 600,000 Australian dollars, then you're going to be liable to pay land tax. Note that this threshold amount is lower for trusts, so for trustees of trusts, I should say, and for companies, as well as what we call absentee individuals, so people who aren't there. So that in that situation, the threshold amount is 350,000 Australian dollars. And note that where you have non-resident companies and trustees for non-resident trusts, they actually have to pay a surcharge as well, which is 2% of the taxable value of the land beyond $350,000. So that there's a surcharge if you're non-resident of that amount. So when we're calculating the land tax rate for individuals, note that this is the more generous one, in that you don't have to pay anything for the first $600,000 worth of cumulative land which you own at the 30th of June. Also note, for some strange reason, that while generally these things increase, the further up you go, in other words, it's progressive, we note that it goes up to 1% for between 600 and 1 million, yet increases to 1.65 and then decreases to 1.25. Not sure the reasons for that, but just note that that's not a typo. So if you are going through and looking at that, and you're welcome to go through the Land Tax Act and Schedule 1 to double check. When looking at the rates for non-individuals, that is trustees and or corporate owners, the threshold amount is $350,000. Also note at the bottom there, I've got the surcharge. Note that it's only a surcharge for amounts above $350,000. That's if you're a foreign company or the trustee of a foreign trust estate. Also note again that the amount goes to 1.7% after $350,000 and then dips back down to 1.5 cents to the dollar and then goes back up to 2.25. Again, I'm not sure the reasons for that. Another thing to note, I haven't included here is the absentee rates for individuals as well. So note that that's a slightly different calculation. They do start with a threshold of $350,000, but they have slightly different numbers from the non-individual rates. So as part of the assessment process, the taxpayer is required to just simply add up the taxable value of each property that they own. And again, if there is some sort of co-ownership or you only own a fraction, or there's some form of partial exemption, for example, you run a business on some fraction of property that might otherwise be exempt. Once you've added all those numbers together and then looked in the scales and determined the amounts at the moment of midnight of the 30th of June, that is the amount that you're going to be assessed to pay. And so, much like in the federal system, the Office of State Revenue is going to send an assessment, and it's going to have a due date. Now, the actual due date for payment is a little bit open because of certain COVID changes that have happened as a result. The state governments have actually been very kind, so to speak. So presently that's 3 months, but that may be subject to change in the near future, and it's currently their discretion. Note that there is also what we call the extended payment option. That is the option to spread payment of land tax over 3 equal payments, 45, 90 and 150 days after this assessment is made. One of the, I guess, important things about land as something that get taxed is that land doesn't go anywhere. Land can't leave the jurisdiction. And as such, when you don't pay land tax, the Commissioner of State Revenue can act upon that. And they're always going to be able to act upon it because the land is still there. So that in a situation where land tax is unpaid, a charge is placed across that. And in a situation where a person both doesn't pay land tax and defaults on a mortgage in regards to that, the Office of State Revenue actually has a statutory power to recover that land tax from the mortgagee. So that in a situation where a person walks from the land, so to speak, and the bank can't claim money back from that particular person, then it'll be the bank itself that'll have to be the ones who will have to cough up to pay the Queensland government for unpaid land tax. Note also that as well as having the statutory powers, it's still an ordinary debt as well. And so the Commissioner can go through the ordinary courts system as part of recovering unpaid land tax as a simple debt. We're going to look now at payroll tax. Now, payroll tax in its simplest sense is a levy on employers. And it's a levy on employers who have a relatively high amount of wages that are paid. Now, payroll tax is different from income tax. That's paid by the employees. Payroll tax is paid by employers. And only a small fraction of employers because the vast majority of employers, sort of 90+%, don't meet the particular threshold for payroll tax. Now, payroll tax was originally actually Commonwealth tax, but for the last 50 years or so, it's been exclusively levied by the states, and it's a pretty important source of revenue for the states and territories. Now, the legislation for payroll tax, because it's not really uniform across states and territories, that there have been efforts to harmonise it. And in terms of the administration of payroll tax and the function of how it works, that's largely succeeded. Queensland, oddly, was one of the holdout jurisdictions, which is why the Queensland payroll tax still dates back to 1971. Many parts of it were changed, and so that it is similar in structure to the big two, New South Wales and Victoria. But it is still an old piece of legislation, and hence the spelling, the old spelling of payroll as a hyphenated word. These days we spell it as one word. Note that while the structure of these acts were generally harmonised, the amounts are not, so that varies across jurisdiction. Note finally there that payroll tax is a state tax, and it's just administered and collected by the Commissioner of State Revenue through the Office of State Revenue, or OSR. So the starting point with payroll tax is that it's levied on wages that are paid out. And the definition of wages is broadened in the Queensland payroll tax legislation. It obviously includes wages in the ordinary sense, but it also includes sort of salary, commission, bonuses, allowances, as well as directors' fees and things that would normally fall under the fringe benefit regime as well. One thing to note about this broader definition is that it's been done by design, and in situations where it might be difficult to determine whether a particular person is an employee or an independent contractor, it is not uncommon for that to really be difficult to ascertain. However, in a situation where it's difficult for the purposes of income tax and sham contracting to ascertain, by design, the payroll tax legislation is set out to encompass those things. And so it is quite a straightforward process for a person who might actually be deemed to be an independent contractor for the purpose of, say, income tax law, to still fall under the payroll tax regime for the purposes of how the employer is levied in regards to payroll tax. Some other things that fall under this broad definition of wage include superannuation contribution amounts that are paid by the employer for the benefit of the employee. They're going to count as wages for the purposes of payroll tax. Also, employee termination payments that are essentially designed to compensate the employee for an amount at a particular point in time. They will count towards the payroll tax regime. However, amounts that are paid to employees to reimburse those employees for expenses they've incurred, that's not going to fall under the definition of wages for payroll tax. It's also not going to fall under the definition for amounts that are paid to employees where they have travelling expenses or motor vehicle expenses, provided that the employer doesn't pay out more than the amount that the ATO prescribe. Now, for those that aren't aware, the ATO prescribe some pretty generous amounts for people travelling for business-related purposes. And they have prescribed amounts for motor vehicles as well in terms of what can be deducted. Now, in that situation, if an employer, for the purposes of state payroll tax, if they pay up to that amount, they're going to be fine, and they're not going to have to include that amount in their calculation for payroll tax. If they exceed that amount, though, and pay essentially more generous amounts for travelling expenses or motor vehicle expenses, then those will be subject to the payroll beyond the ATO mandated limits. One of the important considerations when levying payroll tax is that the particular wages can only apply to things that happen in Queensland. So the wages have to be either performed in relation to services done entirely inside Queensland, or in a situation where an employer is either in another state but the employee is in Queensland, or vice versa. There are some tiebreaker rules, and these are homogenous across the states and territories. And so the key thing to note is that that if they're going to be in one particular state, it's where either the employee is or it's where the employer is. If both of them aren't in Queensland, then you're only going to, in terms of having liability for payroll tax, it's only going to apply in a situation where those particular services have been mainly rendered inside Queensland. Now, when we're trying to determine whether or not a particular employee or employer is based in Queensland, note that it doesn't use the word residence, but the courts actually essentially define this phrase based in Queensland or based in the particular jurisdiction using the ordinary test for residence. That's Applegate's case. That's for employees. So for a natural person who is an employee, they'll be based in Queensland if they meet the ordinary indicia of being resident. In other words, where do they live? Where do they hang their hat? Where do they ordinarily stay? The test for employers, though, for them being based in Queensland, is actually to do with where the ABN is registered. So if a particular employer has an ABN that's registered in Queensland and nowhere else, it's going to be deemed to be based in Queensland. If a particular employer has an ABN in 2 or more jurisdictions, then the test for being based in a particular jurisdiction is where the principal place of business is. Now, as with pretty much every single tax that we've explored throughout this subject, there are some exceptions. And so the straightforward one is that certain types of employer are simply exempt from payroll tax. So religious organisations, public benevolent ones, public hospitals, and primary and secondary schools, but interestingly not tertiary education. Local government bodies incorporated under Queensland law and charities are all going to be exempt from payroll tax blanketly. Now, certain employees, wages paid towards that employee are going to be exempt. So the first category is members of the armed forces. So when a person is away and they have some form of leave for going off and doing things for armed services purposes, then those wages are going to be exempt from payroll tax. Also, wages paid for sort of parental leave, so adoption, surrogacy, or cultural parental leave are all exempt from payroll tax as well. The calculations for payroll tax are pretty straightforward. So the first thing to note about calculating your annual payroll tax liability is that the first $1.3 billion of wages that are paid are just not subject to it, which is why most employers, so sort of 90+% of employers, actually don't pay payroll tax at all. However, in a situation where you are an employer and you do pay more than $1.3 million worth of annual wages, you are going to have to pay, but it's only on every dollar beyond that. And so between 1.3 million and 6.5 million, you pay 4.75% of that. And curiously, once you meet that next threshold of $6.5 million, you actually pay 6.95, slightly higher amount, and that's across all of the amount. So you literally you pay one more dollar in wages, and you end up with sort of $12,000 to $15,000 additional payroll tax for the year. Again, it's not progressive for some reason, I'm not sure. Note that currently regional centres, so Cairns and Townsville, and everywhere in Central and Western Queensland actually has an additional discount on payroll tax. So that's so the amounts, instead of being 4.75 or 4.95, are 3.75 and 3.95 respectively. Employers, when they reach a certain threshold, are actually required to register for payroll tax. And so the first time that an employer pays more than $25,000 in a particular week in terms of wages, it's going to be required to register for payroll tax. The idea being that once you are registered, you actually pay an amount each month, a little similar in many ways to the PAYG system, where you're paying in installments. And then at the end of the year, the Office of State Revenue will examine your final return, so your annual return, and then either demand that you pay any amount which is still owing, or to have refunded the amount of payroll tax that you've paid in excess of the aggregate amount across an entire year. So note that while they have to pay each month, and the formula is extrapolated for the entire year, at the end of each year, the amount is going to be either refunded or you'll pay the balance. The astute of you listening may have already thought of one big loophole in payroll tax, and that's to do with threshold amounts. So it would be trivially simple to set up multiple businesses, be they corporate form or not, and have each one of them have only a few employees. So to get around this, pretty straightforward anti-avoidance systems have been put into place. So here, the idea of grouping provisions, where you've got associated entities. Basically, if you're in a group, you are deemed to be one single employer for calculating the overall amount of wages for the purposes of payroll tax. And these anti-avoidance rules for grouping are expressed very broadly as well. All right, now we're going to look at stamp duty. So stamp duty, which, stamp duty is actually the old term to describe what the Queensland government now refers to as transfer duty. But it is stuck around. The phrase stamp duty is the colloquial term, but it's generally used not just by sort of lay people and business people. It's also often used by the staff themselves. So technically it's called transfer duty, but in practice, if you're trying to convey meaning to another person in terms of what you're talking about, stamp duty is the straightforward way of expressing that particular concept. So stamp duty is an old tax. The idea was in ye old days that when a particular type of document was required to do something, be it obtain a license or to have a transfer of land or some other mechanism where an administrator needed to physically stamp, there was a cost as part of that process of stamping. And this idea of this almost physical nature of stamping being the source of revenue has actually lingered somewhat. And what happened with the stamp duty is that most jurisdictions, I think South Australia is the only holdout these days, did a rewrite. And so that these days it's not the document or it's not the stamp itself that is the tax flows from. It's from the transaction itself. And so certain types of transactions create a liability to pay the commissioner. And those transactions can be, the amount that's payable can be either a fixed amount, so a set amount, or it can be an amount which is proportional or depends on the value, or it can be a mix of the two. The main way that stamp duty arises is through transferring property, and that can be both real and, in some situations, personal property. Now, note that there are some other situations where stamp duty is going to arise, such as when you acquire companies that have land holding, and essentially that's a kind of a pass-through in that you're acquiring real property, but doing it through a corporate entity. So that's that particular component. that stamp duty is going to apply for, much as if you were purchasing the land yourself, for example. It also applies when you acquire partnership interests, so an equitable interest in a partnership, when a trust is created, and each one of those is at ad valorem, so that they are going to be proportionate to the amount. Now, there are two other sort of specific types of situations where stamp duty is going to apply, just because they're mapped out in the statute itself, and that's contracts for insurance, where some fractional part is payable there, and where you register a motor vehicle, both registering it and changing the ownership. So we're going to go through each of these in turn. Okay, now in legal practice, one important place where stamp duty comes up is the conveyance of land. All legal practitioners, or those seeking to enter the legal profession in Queensland, must do a course which involves some aspect of essentially simulating a conveyance. In other jurisdictions, it's not a requirement that a legal practitioner undertakes the conveyance. So in New South Wales, for example, it's actually not a requirement that a lawyer does a conveyance for real property. Here, it is still a requirement. Now, one of the calculations that you really have to be across as a solicitor, if you are going to be doing conveyancing, is the calculation of stamp duty and when it becomes liable. Usually for transfers involving land, it's going to happen when settlement happens. That is, when title passes to that particular property and the various mortgages and charges across a discharge and payment is made. That's what happens with those things. But the actual default for stamp duty for most categories is actually when the agreement's made. The way that the Duties Act is structured is that it says, look, where there's an agreement and there's things are going to pass at some stage later, we're always going to take the earlier of these events. And so that's usually when a particular contract is entered into. Note that the specific rules for motor vehicles mean that stamp duty is paid when registration is transferred or when it arises, when a vehicle is first registered. That is actually done through the Department of Main Roads when you go to change the ownership of your vehicle. For the purpose of transferring dutiable property, that's that first category of things that stamp duty arises for. Note that the Duties Act in Section 10 does define this idea of dutiable property, and it's going to be interesting to note that that actually includes land. Obviously, we know that stamp duty clearly arises for transfers of land and also side areas, but also in the broad sense, an existing right, a Queensland business asset, and a chattel in Queensland. And note there that that this is the legal interest. It's not the sort of the beneficial interest that comes from that. Otherwise, in a situation where you would have sort of a trustee and beneficiary, you'd end up having this quirky situation where the stamp duty will arise for both. So it's usually going to just arise from the legal interest and be payable by the legal owner in that situation, the trustee in the cases of trusts. Now, when we've determined that there is a transfer of dutiable property, then we've got to work out what the value of it is, because it's actually the dutiable value of the property, which we need to know, because the dutiable value is going to be the higher of either the amount, so the unencumbered amount, in other words, excluding any sort of mortgages or securities and such like, and the amount that was paid. So if the amount that's paid is higher than the value of the particular asset, that'll be the amount that's the dutiable value. If, however, it was transferred for consideration which is lower than the value of the property, then it's going to be the listed value of the property that the Office of State Revenue is going to take into account for determining the amount of stamp duty which is liable. Note that when we are looking at amounts that have GST included in them, that the amount that is dutiable is the GST inclusive amount. So if you've got an amount and then you add GST onto it, it's that amount with the GST added onto it It's that amount that we look at for determining the amount of stamp duty that you're going to have to pay. Here we've got the rates that are payable. So the couple of things to note here. First of all, you don't pay stamp duty on dutiable transactions that have a value of less than $5,000. So it's got to be more than $5,000. Now, the amount that you pay is progressive. It starts at 1.5%, goes to 3.5, then 4.5, then 5.75% in a situation where the dutiable value is more than $1 million. That's quite a lot. And note that it doesn't go beyond that, but it's quite an interesting sort of amount, and that difference between sort of 1.5 for smaller amounts of less than $75,000 and 5.75%, that's a really big difference. And I guess as a result, when you're dealing with transactions that involve stamp duty, you should be strategizing ways in which to minimize the amount of stamp duty that your client is going to have to pay, and if that's possible in regards to those transactions, because it's quite a lot of money, and as a fraction particularly of businesses and business assets in a situation where interest rates are at an all-time record low, that this relatively high fraction of the amount that's transferred, it creates, I guess, a situation where you really have to be mindful that you've absolutely crossed your T's and dotted your I's in terms of how and where stamp duty is going to be liable in regards to your transactions. Yet again, where we have a system of taxation and certain classes of persons are exempt from paying it. In the case of stamp duty, charities are exempt. So when they are acquiring dutiable property, charitable institutions, and again, those are the ones that are actually registered under the Commonwealth Charities legislation, they're exempt. Now, other types of incorporated association and actually companies are also going to be exempt from stamp duty when they acquire dutiable property, but if and only if both of these things apply. So first of all, that they provide something related to a purpose that's beneficial to the public. So recreation or amusement, promoting religion, charity, patriotism, or the arts. And the objects of that entity prohibit, so forbid, the distribution of amounts to members. So basically it's set up for the benefit of particular groups or purposes, and the amounts that are left over when the incorporation is wound up are not distributed to members. They are passed on to another entity or institution with a similar purpose. Certain types of transactions themselves are exempt. So I told something of a porky earlier in that chattels are listed as being dutiable property, but in practice there is an exemption that says that chattels are usually exempt from duty. So the idea being that they wanted to have a rule that said chattels are liable to duty, but only in situations when you're either purchasing a business or you're acquiring them in the process of running a business. So that's where you aren't exempt, and acquiring chattels will be subject to stamp duty. Note there that specifically excludes trading stock in a business. Otherwise that would just be very messy. You had to pay stamp duty when you're purchasing things for the purposes of resale or manufacture. That's not, they're not subject to transfer duty. Note also that motor vehicles, which are technically chattels, are most certainly not exempt, but the rules for motor vehicles are specifically mapped out in the Duties Act itself in Chapter 9. But also note that as an exception to that, non-exemption, that where you have certain motor vehicles that are transferred to disabled people or to ex-service people that are in receipt of some form of disability pension, to trade unions for the purposes of doing trade union things, to local governments, and to your own family members are going to be exempt transactions. So in a situation where you, for example, gift or sell to your a child, for example, a motor vehicle for either a trivial consideration or a below market value, that's going to be fine. You don't pay stamp duty in those situations. But note that the classes of persons defined as family members is stipulated in the legislation itself. Another huge area for exemptions to stamp duty is assets that are transferred under the family law provisions. Now, this is an important area for legal practitioners who end up in this area of law, because importantly, when property is transferred by a court order, and that can also be an order by consent, that's where the parties to a separation come together to agree on the particular order, then they get the court to essentially stamp that, to sign it off. Of course, I'm not going to say no, provided that it's on the face of it, it's not inherently unjust. So when that happens, then the property is transferred and no stamp duty arises. Okay, so it's important because not only will some of you possibly having to get in a situation where you're having to advise people in regards to these things, it's important to be over these rules. Also note that a relatively recent change that in Part 19 of the Property Law Act in Queensland allows property that's transferred into and out of a de facto relationship to also be exempt from stamp duty. This is a relatively recent change to the family law system, and it can be done by a court order, or it can be done under what's called a formal agreement under the Family Law Act itself. So it is important to be over this. It's important to be aware that in certain situations where couples are coming together or they're separating, that the property which is transferred in that situation, in most situations, is going to be exempt from stamp duty. So the last thing I just want to say about stamp duty is actually a piece of practical advice. There's two things to note. First of all, I guess studious types who've studied law for a long time would know that in some situations you actually don't need a written instrument to transfer property. However, in a situation where stamp duty is going to arise and you've transferred it without a written instrument, you have to create a written document. You've actually got to, on the approved form, you actually have to inform the Office of State Revenue that this particular transaction's been done as part of that. So that's a legal requirement, and there is actually a penalty, I believe 20 penalty units for maximum for failing to comply with that. There's another piece of practical advice or information that I'll just arm you guys with, and that's to do with trusts. Now, you may be aware that trusts can be done orally, although you'd be crazy to do that for any large sum of money or property. So the most common way to create an intentional trust is to do so with a trust deed. This is often, by the way, done by accountants rather than lawyers. And so for those budding accountants amongst us, you probably should be over the rules for deeds and the witnessing thereof. And one thing to note that in Queensland, it's common for trust to be established by a settlor using simply a $10 note. So that trust is established by unconditionally and without possibility of retrieval. The settlor vests that $10 note into the hands of the trustee, who must be a separate and different person. And you do that, it's we call it a $10 trust. That's a common way for creating a trust in Queensland, with the idea being that once that is created, then property is transferred into that particular trust, again by a variety of mechanisms. One of them being through family law orders. That can be a situation where you can set up trusts. But note that when you do move real property into trust, that it will become liable for stamp duty by default unless it's been done under such an order. Now, another thing to note is that lenders, so the big four banks and other lenders, in a situation where you have a discretionary trust and you've created this instrument, they like it to be registered in some way. And you'd be aware that there is actually no system of registration for trust deeds. And so it's sort of the de facto mechanism or system is once a $10 trust has been established, for it to actually be sent off to the Office of State Revenue and for them to see it, cite it, stamp it, and record that no duty has been paid because the amount is less than $5,000. They will still charge a fee, $30, $40, $50 in order to do that. But that creates a formal record. And the lenders actually prefer to have a document that has been essentially witnessed in that way. So that's just something to tuck away in the back of your mind in regards to discretionary trusts created by deed. The next area of taxation that we're going to look at just briefly are council rates. So local governments are statutory bodies created under the Local Government Act 2009 in Queensland, and they actually have the power to levy their residents, so people within that particular area. We call this levy, which is in and around the services that are provided in relation to the ownership of land in that area, land and buildings. We call these things rates. Sometimes they're known as rates and charges, but these rates are essentially a tax. And these local government bodies, they've got wide scope to do this and to set the amounts. Note, though, that because they're doing it under delegated legislation, they can't exceed the power that's given to them. And when setting these rates, they have to do so in a logical and reasonable way. When levying rates, the local government bodies, and again, I'll just refer them all as councils, even though we're also talking about regional councils and shires and so on. But in regards to our local area here, they will set an amount for what are called general rates. And the idea of general rates is that these are levied specifically for the purpose of the community as a whole and not particular classes of persons as part of that. Those are general rates. Now, they can also have what are called special rates. The special rates can be levied on particular persons who have some particular or special association with a particular area or particular packets of land. The councils do have power to levy rates in regards to particular persons or categories of persons. And finally, you have utility charges. These are for the utilities that are supplied by local governments. That's waste management, gas, sewage and water. So these general rates are levied usually actually on the improved value of land. So unlike land tax, council rates look at the improvements that are on land for determining the amount that a person has to pay through their general rates. In regards to special rates and also charges for utilities and other such rates, their local councils have a lot of discretion. So they, again, provided that they use that power reasonably, they can apply those things somewhat discriminately towards particular categories of persons and those that own property in particular areas of which that council has control and the ability to levy rates over. So finally, we just need to note that this delegated authority that these local government bodies have also allows them to map out a process for recovering amounts from ratepayers who just don't pay their rates. And so that this administration is actually managed by each of the local government bodies themselves. They're given power to do it, but the actual process they use very much varies. Now, also note that as part of the process of determining how much rates a particular person is going to have to pay, when they're looking at the value of land, this assessment and the categorization of lands for particular types of use, each of those things is capable of being objected to. Much like when, for example, the Federal Commission of Taxation makes an assessment, there is this objections process with local governments where they make these zoning categorizations. You can object to those. You can also object to your particular assessment. The actual land valuation, while you can object to that, that's done with the Department of Natural Resources and Mines. It's not done through the councils. Finally, if you don't pay your rates, there is a statutory charge which is placed upon that particular land, and that local government body can exercise that charge and exercise their power of sale in regards to that. Again, it's also a debt, and so that they can also take the particular ratepayer who hasn't paid through the ordinary court system if they desire. So I'm hoping that this was a useful overview of this particular area of law. You've picked up a few things here and there, and that it's worthwhile.